Hi, I'm Joe, a Canadian citizen living in Central Europe. With the price of gold reaching $3,000 US per ounce on March 17, 2025, it may surprise you to learn that as of mid-February 2016, the Bank of Canada has held exactly zero gold in its international reserves, as in not a single bar, coin, or wafer. While many mostly minor third world states hold no gold, there is something just a little odd about seeing a country as resource-rich as Canada in the same company as Armenia, Azerbaijan, Cameroon, Oman, and Nicaragua, while states such as Malta, Uruguay, Burundi, Fiji, and Kenya can all boast holding more gold than Canada. While a handful of Western countries such as Croatia, Israel, New Zealand, North Macedonia, and Norway likewise hold zero gold reserves, Canada's situation is so atypical that it is currently the only member of the G20 to not hold any gold reserves. Curiously, a CBC article from the time reporting on the liquidation of the last of Canada's gold states that, at one point, the Bank of Canada held about 1,000 tons of gold, which, if it had simply kept those reserves up to the present day, would give it the 8th largest central bank reserves in the world. So how did this happen? In the first part of today's presentation, I'm going to attempt to tell the story of Canada's gold reserves from 1951 up to the present day. In addition to looking at the ebb and flow of those reserves over time, I will also overlay Canada's gold reserves over a timeline showing Canada's ruling parties, prime ministers, finance ministers, and governors of the Bank of Canada in order to look for any correlations or patterns between who occupies those positions and the liquidation of Canada's gold reserves. Next, I'll examine the theoretical reasons why a central bank would even hold gold reserves in the first place, and then scrutinize the Canadian government's stated rationale behind this policy. I'll then contrast those statements with those of central banks that are actively hoarding as much gold as possible, such as the National Bank of Poland, in order to gain a better understanding of the pros and cons of holding gold. I'll then try to determine how the Government of Canada's policy of holding zero gold reserves could affect the nation in the future, before trying to identify who is responsible for putting Canada in this situation. I'll then conclude the presentation with some speculation on what I think is really going on with this policy. Data on the Bank of Canada's international reserves can be obtained from several sources. The first is the Bank of Canada's website, which gives weekly reporting of the value of its various reserves expressed in millions of US dollars from July 1999 to present, while monthly figures for January 1951 to December 1999 are available from StatsCan. However, the primary source of data for this presentation will be the International Monetary Fund's International Liquidity Database, which not only gives the value of gold reserves in millions of US dollars, but also reports on the physical amount of gold held in millions of fine troy ounces. As a reminder, one fine troy ounce equals about 31.1 grams, but for convenience sake, I will convert these figures into metric tons throughout the presentation. This data on physical holdings is particularly useful as the methodology for calculating the value of gold reserves in millions of US dollars changes at several points, as will be discussed, and so the figures for the actual physical amounts of gold held allows us to see precisely what was happening with the gold reserves at various times. I will also compare the Bank of Canada's reported gold reserves alongside the average monthly price of gold taken from the website macrotrends.net in order to see if there is any correlation between fluctuations in gold reserves and the market price of gold. Now on to the presentation. In January 1951, Canada was just over 2 years into the Liberal government of Prime Minister Louis St. Laurent, whose finance minister at the time was Douglas Abbott. Meanwhile, the Bank of Canada was under the leadership of Graham Towers, Governor of the Bank of Canada since its inception in 1934, and who, in 1951, was in the middle of his third and final term. In July 1954, Finance Minister Abbott was replaced by Walter Harris, while in January 1955, Governor Towers was replaced by James Coyne. During the period under Governor Towers and continuing under Governor Coyne, we see gold reserves steadily increase from 529 tons in January 1951, nearly doubling to 1,015 tons in November 1955, before stabilizing at around 980 tons in 1956. On June 10, 1957, Canada elected a minority conservative government led by John Diefenbaker, who appointed Donald Fleming as his finance minister, while James Coyne continued his tenure as governor of the Bank of Canada before being replaced in July 1961 by Louis Resminski. 9 months later, on March 31, 1958, a second election was held that resulted in Diefenbaker receiving the largest parliamentary majority in the country's history, along with nearly 54% of the popular vote. After gold reserves stabilized at 980 tons throughout 1956 and 1957, there is a gradual decrease throughout 1958 until June and October 1959, when we see reserves drop by about 100 tons to around 855 tons. From there, reserves continue a gradual decline, reaching a low of 785 tons in March 1961, though recovering slightly to 810 tons at the time of Coyne's resignation that July in the midst of several political scandals. This period in Canadian political history was marked by several scandals involving the Bank of Canada, the first being an open conflict between Diefenbaker and Coyne over monetary policy, with Diefenbaker favoring a policy focused on increasing the money supply with the aim of generating low interest rates and incentivizing full employment. Meanwhile, Governor Coyne publicly criticized the government's policies and, in response to inflation, ordered a reduction of the money supply. Another controversy emerged as a result of Coyne's pension, which he had increased to $25,000 per year. For this, Diefenbaker tried to remove him from office, with the House of Commons even passing a bill to that effect, though it was subsequently blocked by the Liberal-controlled Senate. Coyne resigned the next day, but still managed to embarrass the government by keeping his pension, with Coyne living happily ever after and ultimately passing in 2012 at the ripe old age of 102. Following Coyne's resignation, Louis Resminski was appointed as governor, and under his tenure, we see reserves increase to 855 tons in April 1962, before the sudden liquidation of 216 tons that June, leaving only 594 tons. So what was happening in June 1962? The first half of 1962 was a politically and economically volatile year for Canada. Parliament was dissolved on April 19th ahead of the June 18th federal election, and in that time, several political and economic forces came to a head. In response to a weakening dollar, the government devalued the Canadian dollar to 92.5 cents US, whereas it had previously floated between 95 cents and parity with the US dollar. This move was widely unpopular and greatly harmed Diefenbaker's re-election campaign, as satirical Diefendollars were printed and widely circulated throughout the country. Following the June 18th election, which saw Diefenbaker lose his historic majority and emerge with a minority government that would be defeated a year later, on June 24th, in response to continuing pressure on the Canadian dollar, the government, under Finance Minister Donald Fleming, announced a major economic and financial program aimed at restoring confidence in the Canadian dollar, which presumably included selling off around 216 tons of gold, worth about $244 million US. Here I have included a summary of Canada's international reserves at the time, and we can see that in addition to selling off gold, the government effectively doubled its holdings of US dollars from $593 million to $1.1 billion, and also completely liquidated its reserve position in the IMF. Shortly after the June 1962 election and monetary crisis, we see gold reserves gradually increase once again. Meanwhile, in August, Finance Minister Donald Fleming was appointed as Justice Minister, at which time George Nowlan was appointed as the new Finance Minister. Another election was held on April 8, 1963, that resulted in Diefenbaker's conservative minority government being replaced by a liberal minority government led by Prime Minister Lester B. Pearson, who in turn appointed Walter Gordon as Finance Minister, while Louis Resminski remained Governor of the Bank of Canada. 2 years later, another election was held on November 8, 1965, which saw Pearson's minority government gain a few additional seats, following which Finance Minister Gordon was succeeded by Mitchell Sharp. Throughout Pearson's tenure, gold reserves continued to recover from the massive sell-off in June 1962, peaking in December 1965 at the all-time high of just over 1,022 tons of gold, as mentioned in the CBC article. For the remainder of Pearson's tenure following Sharp's appointment as finance minister, holdings then fluctuate between 876 to 986 tons in November 1967, before starting to decline throughout the final months of Pearson's second term. In April 1968, another election was held following Pearson's resignation, with the Liberal Party, now led by Pierre Trudeau, winning a majority government. Throughout Trudeau's tenure, he would regularly swap finance ministers roughly every 3 or 4 years, starting with Edgar Benson in 1968, future acting Prime Minister John Turner in January 1972, Donald Stovall MacDonald in September 1975, and future Prime Minister Jean Chrétien in September 1977. Trudeau's tenure was briefly interrupted following the election of a minority Conservative government led by Joe Clark in September 1979, but his subsequent election in February 1980 saw Trudeau return, at which time he appointed Alan McEachern as finance minister, who was in turn succeeded by Marc Lalonde in September 1982. Trudeau would remain in office until his resignation in June 1984, at which time former finance minister John Turner became acting prime minister until an election could be held that September. As for the Bank of Canada, Louis Rosminski was succeeded by Gerald Bowie in February 1973. It is during this period that analyzing Canada's gold reserves becomes somewhat complicated as a result of several changes that occurred in the monetary system around this time. As a quick refresher, recall that at the beginning of the 20th century, the value of the US dollar was set at 1/20th of an ounce of gold, thus setting the price of an ounce of gold at $20.67 US. In 1933, U.S. President Franklin D. Roosevelt signed an executive order banning the private ownership of gold and, following the mass confiscation of gold from the U.S. citizenry, devalued the U.S. dollar from 1/20th of an ounce of gold to 1/35th of an ounce, setting the price of gold at $35 US per ounce, thus allowing the government to expand the money supply. In the aftermath of World War II, the Breton Woods system set the US dollar as the international reserve currency and was backed by gold, with the conversion rate from other currencies set to the US dollar. Up until this point in the story, the value of Canada's gold reserves was calculated by simply multiplying the number of ounces of gold held by 35 US dollars in order to determine the value of those reserves in millions of US dollars. However, in 1969, the International Monetary Fund created what is called special drawing rights, after which time the value of gold reserves were calculated first in units of SDRs before being converted into US dollars for reporting purposes. According to the IMF, a special drawing right is a supplementary international reserve asset created at a time when currencies were tied to the price of gold and the US dollar was the leading international reserve asset. The SDR itself is not a currency, but an asset that holders can exchange for currency when needed. Initially, the IMF defined the SDR as equivalent to a fractional amount of gold that was equivalent to $1 US, so that 1 ounce of gold, then valued at 35 US dollars, was now valued at 35 SDRs. The next major change to occur during this period happened on August 15, 1971, when U.S. President Richard Nixon ended the convertibility of the U.S. dollar to gold, effectively bringing an end to the Breton Woods system, at which time the price of gold became free-floating and determined by the market. Following Nixon's order, the price of gold quickly began to rise from its original price of $35 US per ounce and would double on 4 separate occasions by the end of the decade, reaching $70 in February 1973, $140 in February 1974, $280 in June 1979, and, in response to the Soviet invasion of Afghanistan, surpassed $560 in January 1980, on the way to a peak of $677.97 per ounce, though some sources say it was actually $830, resulting in an over 1,900% increase in just under a decade. In 1973, when fixed currency exchange rates ended, the IMF redefined the SDR as equivalent to the value of a basket of world currencies, the value of which changes daily. So whereas 1 SDR was originally equivalent to $1 US, As the currency exchange rates began to float, so did the exchange rate between SDRs and US dollars, with the value of an SDR generally fluctuating at between 0.9 to 1.4 US dollars. As a result, the price per ounce used in calculating the value of gold reserves could vary between about 34 to 46 US dollars. Therefore, with the nominal value of an ounce of gold set at 35 SDRs from 1969 until June 1999, the value of gold reserves was determined by first multiplying the number of ounces of gold held by 35 SDRs and then converting SDRs to US dollars using the SDR-USD exchange rate in effect at the time, which I show here for the years 1981 to 1989. This practice continued up until June 1999, when the bank finally started reporting the actual market value of its gold reserves by simply multiplying ounces by the market price per ounce in US dollars. This reporting methodology does confuse things, however, particularly after the price of gold itself begins to float in 1971, as the reported value of gold reserves determined using this methodology becomes completely detached from the actual market value of those gold reserves. Here I have calculated the difference between the reported value of the bank's gold reserves from 1972 to 1984 against the actual market value to show by just how much these two values diverge, with January 1980 being the most extreme example. At the time, the Bank of Canada reported the value of its gold reserves at just over $1 billion US dollars, held in just under 22 million fine troy ounces of gold, or about 681 metric tons, calculated using an SDR-USD exchange rate of 1.31 US dollars. The absurdity of this methodology becomes readily apparent when you then multiply the number of ounces of gold held by market price at the time, which reveals that the true market value of those gold reserves was almost 15 billion US dollars, whereas the reported value for the Bank of Canada's entire international reserves were only just over 4 billion US dollars, so that is quite a discrepancy. Returning to Canada's gold reserves, following the peak of 986 tons in November 1967 under Governor Rasminski, we saw reserves decline throughout both the remainder of Lester B. Pearson's tenure and into the first 2 years of Pierre Trudeau's tenure, before stabilizing throughout most of 1970 at about 780 tons, though 80 tons would be liquidated that December, bringing reserves down to 702 tons. Between 1971 and 1973, reserves were largely stable, varying only slightly between 702 to 705 tons for 71 and the first half of 72, before dropping to 682 tons in the middle of 1972 and largely remaining at that level, though with some minor fluctuations, until January 1980. The fluctuations we see in the reported value of gold reserves during this time are due to the fluctuations in the exchange rate between IMF special drawing rights and US dollars, rather than a reflection of market price. After the historic peak of January 1980, the price of gold underwent a significant correction not long after and spent the next 25 years trading around an average of $350 US per ounce, while the price of gold would not surpass its record 1980 price until 2006. Throughout the 90s, central banks, most notably the Bank of England, were selling off significant gold reserves, placing heavy downwards pressure on the price of gold, resulting in agreements between various central banks to limit the amount of gold they would sell off on an annual basis. In 1980, as the price of gold reached its record high, and after 7 years of Canada's gold reserves being maintained at a nearly constant level, a decision was made to implement a new strategy in the management of Canada's gold reserves. According to the Bank of Canada, in 1980, the government implemented a policy of selling its gold at a gradual and controlled pace to enhance the return for the EFA. Proceeds from gold sales were invested in interest-bearing foreign currency assets. We can see the apparent implementation of this plan as early as January 1980, when, following several years of relatively stable holdings, about 8 tons were sold off that month alone, with just over 29 tons being liquidated by the end of the year. This policy continues throughout the remainder of Trudeau's tenure, though slowing over time, possibly in response to the correction in the price of gold that started in late 1980, as only 15.5 tons were sold in 1981, under 6 tons in 1982, less than 2 tons in 1983, and just a single ton in 1984. Following Pierre Trudeau's resignation in June, an election was held on September 4th, which saw the Conservatives, led by Brian Mulroney, win another historic majority government, while also receiving above 50% of the popular vote. Mulroney appointed Michael Wilson as finance minister, while Gerald Bowie continued on as the governor of the Bank of Canada until being succeeded by John Crow in February 1987, while finance minister Wilson was replaced by Don Mazankowski in April 1991. Mulroney resigned as Prime Minister in June 1993 and was replaced by Kim Campbell, who appointed Gilles Lucel as Finance Minister, though Campbell's Conservative Party would be utterly annihilated by Jean Chrétien's Liberals in the October 1993 federal election. When Brian Mulroney was sworn into office in September 1984, the Bank of Canada still held 627 tons of gold. Those holdings remained relatively stable throughout 1985 and most of 1986 when, in the final months of Gerald Bowie's tenure at the Bank of Canada, we see the liquidation of gold reserves resume, with 13 tons being sold off between August and December. Following the appointment of John Crow as governor in February 1987, the sell-off continues, first at about 3 to 4 tons per month from 1987 to 1991, before increasing to about 7 tons a month throughout 1992 and 9 tons a month in 1993. By the time the Conservatives lost the October 1993 federal election, a total of 417 tons of gold had been sold off during their time in office, leaving just under 210 tons remaining. It's worth noting that most of this gold was sold off at a time when the price of gold was largely stagnant at around $350 US per ounce. So what was happening with the other reserve assets held by the Bank of Canada during this time? After all, the bank did say that proceeds from gold sales were invested in interest-bearing foreign currency assets. Here we can see all categories of reserve assets from 1984 to 1993. Remember that the reported value of gold was not based on actual market value at the time. So, for example, the 627 tons of gold held by the bank in September 1984 were valued by the bank at only $706.7 million US dollars, while in reality had a market value of $6.8 billion. From 1984 until about October 1986, the bank's international reserves remained relatively stable. Between October 1986 and October 1988, we see the bank's holdings of US dollars massively increase by about $11 billion, during which time the bank likewise sold off about 2 million fine troy ounces of gold, which, based on the average market price at the time of about $438 US dollars per ounce, had a value of about $940 million US dollars. We then see a significant expansion in the holdings of foreign currencies as, from October 1988 to December 1991, those holdings increased by almost $4 billion, during which time the bank sold off about 4.8 million ounces of gold with a value of about $2 billion. Curiously, between 1992 and 1993, when the bank sold off an additional 6.5 million ounces of gold, worth roughly $2 billion, we actually see the bank's total international reserves drop from 16.7 to 12.7 billion US dollars, primarily through the near total liquidation of about $4 billion of foreign currencies, in addition to the sale of $2 billion of gold. Following the utter annihilation of Kim Campbell's Conservative Party in the October 1993 federal election, a majority Liberal government was elected, led by Pierre Trudeau's former finance minister Jean Chrétien, who appointed Paul Martin as finance minister, who remained in that position until being succeeded by John Manley in 2002. Martin himself would become prime minister in December 2003, following Chrétien's resignation, at which time Martin appointed Ralph Goodale as finance minister for the remainder of his tenure. Meanwhile, in the Bank of Canada, John Crow's term as governor ended in January 1994, being succeeded by Gordon Thiessen the following month, who was in turn succeeded by David A. Dodge in February 2001. As you can see, virtually all of Canada's remaining gold reserves were liquidated during Jean Chrétien's tenure. The Bank of Canada held about 209 tons of gold when Chrétien took office, and only 3.39 tons of gold remained on the day Paul Martin was sworn in. As mentioned earlier, in June 1999, the Bank of Canada changed its methodology for calculating the value of its gold reserves by now simply multiplying the number of ounces of gold held by the market price in effect at the time. Here we can see how the reported value of gold holdings increases from $103 million in May to $572 million in June, despite physical holdings remaining unchanged between those 2 months. In December 2003, the plan implemented in 1980 to liquidate Canada's gold reserves was largely complete, as the Bank of Canada reported that, in December 2003, the government sold its last gold bullion. The report added, This policy has greatly benefited Canadians. Since the start of the gold sales program in 1980, reserve asset income has been $13 billion higher than it would have been had the government maintained its gold bullion. Curiously, the implementation of the 1980 decision to liquidate Canada's gold reserves was largely carried out after the price of gold peaked, underwent a significant correction, before stagnating for the next 25 years. At the time the sell-off of gold was completed, the price of gold was just starting a decade-long rally in which the price rose from a low of about $275 an ounce in December 2001 to $1,825 an ounce in August 2011, an increase of about 680% in a decade. For those keeping track, that's also a 5,200% increase in price since 1968. I have attempted to calculate the value of all the gold sold between January 1980 and December 2003, and I estimate those sales netted the bank about $8.27 billion, which the bank claims they were able to reinvest for a return of $13 billion. Had the bank simply held on to the 21.816 million fine troy ounces of gold sold during that time, as of December 2003, that gold would have been worth about $8.86 billion. Looking forward in time, those reserves likewise would have been worth $9.6 billion in December 2004, $11 billion in December 2005, and $13.7 billion in December 2006, just 3 years after the last bullion was sold. Of course, at the peak in August 2011, those holdings would have been worth nearly $40 billion, at a time when the Bank of Canada valued its total reserves at $63.2 billion. If the bank had held on to those 21.816 million ounces of gold into 2025, they would now be worth $72.4 billion when total reserves were $124 billion. In both instances, those gold reserves would have been the bank's most valuable reserve asset. The bank's report also notes that, as of the end of December 2003, the government's remaining gold reserves were comprised entirely of gold coins, which amounted to 3.39 tons of gold. Curiously, the sale of bullion wrapped up almost to the day Paul Martin was sworn in. Martin was sworn in on Friday, December 12, 2003, and checking the Bank of Canada's weekly reports, we see that on Monday, December 8th, the bank reported the value of its gold reserves at $70 million, while a week later, Monday, December 15th, that had dropped down to $44 million, consistent with the physical amount of gold the bank would continue to hold going forward. Paul Martin's Liberal government was defeated in a motion of non-confidence on November 28, 2005, resulting in an election being held on January 23, 2006, which saw the Conservative Party, led by Stephen Harper, win a minority government. Harper appointed Jim Flaherty as finance minister, who remained in that position until being succeeded by Joe Oliver in March 2014. Meanwhile, David A. Dodge continued on as governor of the Bank of Canada until being replaced by future Prime Minister Mark Carney in February 2008, with Carney remaining in that position until his resignation in June 2013 to lead the Bank of England, at which time he was succeeded by Stephen Poloz. During this period, the price of gold continued the recovery started in December 2001, and by January 2006 had increased to $550 per ounce, a 25-year high, before ultimately peaking at $1,825 per ounce in August 2011, a 330% increase in 5 years. Gold then stabilized at around $1,600 for most of 2012, before gradually declining to about $1,000 per ounce in late 2015. During this period, the government purchased no gold and did not sell off a single ounce of gold until November 2012, when the Bank of Canada began to sell off some of the gold coins it retained following the sell-off of Canada's gold bullion in December 2003. Commencing in November 2012, during the final months of Mark Carney's tenure as Governor of the Bank of Canada, and ending in January 2014 under the tenure of Stephen Poloz, the Bank of Canada sold off 30,000 of the higher quality gold coins remaining in its reserves. According to the bank, the centennial anniversary sale of King George V $5 and $10 gold coins dated 1912, 1913, or 1914, which was officially launched in November 2012, concluded in January 2014. On behalf of the Government of Canada, the Royal Canadian Mint sold all of the 30,000 high and medium quality gold coins held in the EFA. The program generated revenue of over $25 million Canadian for the EFA over 2012 to 13 and 2013 to 14. After accounting for overhead costs, which included packaging, advertising, transportation, and program management fees paid to the Royal Canadian Mint, the net profit to the EFA was approximately 23 million Canadian. The 30,000 gold coins contained over 13,000 ounces of gold. The proceeds from the sales have been reinvested in highly liquid securities consistent with the policy objectives of the EFA. The report also states that at the end of March 2014, the EFA held 95,895 ounces of gold in the form of low-quality King George V coins. The government also retained 36 pristine King George V coins, representing 6 sets of each denomination and year for archival purposes. Curiously, this sale marked the end of a 12-year period, starting in December 2003, in which the Bank of Canada did not sell off a single ounce of the 3.39 tons of gold coins remaining following the sell-off of Canada's gold bullion. Throughout the life of this sales program, the price of gold dropped from $1,726 per ounce in November 2012 to $1,251 per ounce in January 2014, and following the conclusion of the sale, the liquidation of Canada's gold reserves once again came to a halt. Another election was held on October 19, 2015, which saw the Liberal Party of Canada, led by Justin Trudeau, receive a majority government. Trudeau appointed Bill Morneau as finance minister, and both were sworn in on November 4, 2015, while Stephen Poloz remained governor of the Bank of Canada. Curiously, 1 month later, the Bank of Canada began selling off the final remnants of its gold reserves, and by the end of February 2016, Canada became the only country in the G20 to officially hold zero gold reserves. According to the Bank of Canada, in 2014, after the completion of the gold sales program, which made available 30,000 medium to high quality coins for sale to Canadians, the exchange fund account held approximately 216,000 low quality King George V $5 and $10 gold coins dated 1912, 1913, or 1914, which bore imperfections and carried little numismatic or collector's value. The 216,000 low-quality King George V $5 and $10 coins were melted, and the resulting bullion was sold at market prices. The government took a policy decision in the early 1980s to divest its gold holdings in order to improve the liquidity of its reserves, consistent with the objectives for holding foreign reserves. In addition to improving the overall liquidity of the foreign reserves, the purchase of high credit quality fixed income securities with the proceeds of gold sales reduced the volatility in the value of the reserves and provided the government with interest income that compounds over time, which is not the case for a commodity such as gold. Now, I find these statements rather curious given that the price of gold has largely been on an upwards trajectory for the past 54 years, having increased by over 3,200% at the time the last gold was sold. And I also have to wonder why they picked that moment to sell off the gold. When the sale started the week of December 8th, the price of gold was at the lowest it had been since October 2009. Since the Bank of Canada sold off the last of its gold reserves in February 2016, the price of gold has increased by over 300% and is currently hovering around $3,350 per ounce. In retrospect, if the Bank of Canada had simply held on to the nearly 682 tons of gold it held in January 1980, those reserves would be worth almost $74.5 billion today. Had the bank held on to the 1,022 tons it had in December 1965, those reserves would now be worth $110 billion. The report concludes the story of Canada's gold reserves by noting that, subsequent to March 31, 2016, 36 high-quality King George V $5 and $10 coins were sold to the Bank of Canada Museum and the Royal Canadian Mint for a consideration of $1. The sale of these historically important coins to the museum and the mint is intended to ensure that the coins are appropriately safeguarded in keeping with their historical value and remain accessible for current and future generations of Canadians to view. In this context, a condition of this sale is that the museum and the mint have agreed to protect these coins indefinitely and make these coins available from time to time to Canadians for viewing at the museum and mint or through a loan of the coins. And thus ends the story of Canada's gold reserves. On the bright side, at least you can still see what's left of Canada's once mighty gold reserves in a museum. Now that we know what happened to Canada's gold, Next, I'd like to examine why central banks even need gold reserves in the first place, but let's first quickly review the connection between gold and human civilization. Looking back at the last 3,000 or so years of human history, gold is money, with its value determined by its actual physical amount, as opposed to by what number or whose face is stamped onto the coin. The concept of the value of gold has spread to all corners of the earth and survived every conceivable disaster and calamity that humanity has suffered in all that time. Wars, plagues, natural disasters, collapses of empires, atomic bombs, you name it. And while I can conceive of a scenario where the very concept of money becomes completely meaningless, no catastrophe in recorded history has yet brought about such a situation, and truthfully, I don't see it happening, or at least persisting for an extended period of time. The way I see it, as long as there are groups of humans remaining on the planet, at some point they probably will find it advantageous to engage in trade with other groups of humans, or with each other, as has been the case for practically all of human history. Anyhow, skipping ahead a few thousand years, around 1873, the world saw the global implementation of a monetary system known as the gold standard, under which paper currency was directly convertible to gold on demand. In essence, the paper money was just a claim to physical gold, and at any time you could exchange the paper money for the gold. This meant that the government issuing the paper money, in theory, should have that gold on hand at all times in case it was demanded by an entity holding its paper currency. This also meant, in theory, that a government should not print more money than it could exchange for the gold it had, hence why central banks and governments had to hold gold reserves. One benefit of this system is that it strictly controls inflation, which doesn't seem like such a bad idea these days, as, in theory, the government cannot increase the money supply by simply printing more paper money than it has the gold for. But this characteristic can also create economic challenges as well, and in times of crisis, such as World War I, many countries suspended the gold standard. The gold standard would persist through several iterations, such as the Breton Woods system established after World War II, until it was suspended outright by U.S. President Richard Nixon in 1971, at which time all currencies became fiat currencies, meaning they only have value because governments say they do. Canada, both as the Province of Canada and later the Dominion of Canada, was on the gold standard from August 1, 1854 until the outbreak of World War I. Initially, a Canadian dollar was defined as being equal to 15/73 of a British gold sovereign, and when you do the math, that gives an exchange rate between the British pound and Canadian dollar of 4.867. In 1910, the Canadian dollar was redefined in relation to ounces of fine gold so that it became the exact equivalent of the US dollar, which itself was defined as 1/20th of an ounce of gold. The Canadian government would suspend the gold standard upon the outbreak of World War I, but would reinstate it on July 1, 1926, only to suspend it permanently in January 1929, at which point the value of Canada's dollar was either free-floating or pegged to the US dollar. The Government of Canada began producing $5 and $10 gold coins in 1912, but suspended production in 1914. These coins were the coins that remained in the Bank of Canada's reserves following the sell-off of all bullion in December 2003, and were the coins that were melted down and sold off in late 2015 and early 2016. Following the collapse of the Breton Woods system between 1971 and 1973, all currencies were now fiat currencies whose value was no longer linked to any physical thing, such as gold. So why would central banks even bother holding gold? Several articles I read on the subject pretty much regurgitate the same points, all of which seem pretty reasonable to me. The most obvious point is that, as an investment, gold is first and foremost a store of value and a hedge against inflation. As prices go up and currencies lose value, gold maintains the purchasing power that was placed into it initially, while a defining feature of fiat currencies is that they will eventually lose all their value. Holding gold also helps to diversify a country's reserves and enhance its creditworthiness. The confidence those reserves instill in investors may lead to reduced borrowing costs as investors view the country as a safe haven. Furthermore, in times of economic crisis, gold reserves provide stability and boost confidence in that country's currency, and can act as a buffer by providing liquidity and ensuring the smooth functioning of the financial system. It also acts as an investment safe haven as the value of gold typically increases during times of economic or geopolitical volatility. In addition, gold, being a physical asset that you normally keep in your physical possession, does not carry counterparty risk. That is, the financial risk inherent in contracts wherein a party, such as a foreign government, may not fulfill their contractual obligations. Finally, gold also plays a role in international trade settlements. For example, it can be utilized in a balance of payments crisis, such as in the 1997-98 Asian crisis, or be utilized to cover essential imports or to shore up a domestic currency, and it can also serve as collateral for loans. As with any investment, gold does carry some risks, namely the cost of storing and securing physical gold, and the risks associated with price volatility. However, given the fact that the price of gold has only gone up over the long term and will probably hit 10,000% since 1971, by the time I finish producing this presentation, that doesn't seem like a deal breaker to me. Another challenge that could arise with holding gold is that focusing too heavily on gold could tie up valuable assets that, at a national level, could be used for other purposes such as infrastructure development or social programs. Thus, diversifying reserve assets is essential. With that in mind, let's now examine the government's stated reasoning behind this policy of holding zero gold reserves. The final sell-off of early 2016 was reported by a number of media outlets, and in one such article, the CBC quotes Finance Department spokesman David Barnaby as explaining, "The government has a long-standing policy of diversifying its portfolio by selling physical commodities such as gold and instead investing in financial assets that are easily tradable and that have deep markets of buyers and sellers." In a critique of this policy, David Chapman, chief economist of Bullion Management Group, argues that gold, however, is not a commodity, it is money itself, as it has been for over 3,000 years. It is traded daily on the currency desks of major banks around the world. That puts gold in the same category as the US dollar, the euro, and other currencies. The physical gold market is estimated to have a daily average turnover of upwards of $24 billion daily in both cleared and uncleared OTC markets, according to statistics from the London Bullion Market Association. This makes daily gold turnover trading in the London market on par with the major currencies and larger than all bond markets except for the US Treasury bond market and the Japanese government bond market. Gold trades in one of the most liquid markets in the world. And I agree with Chapman. Just go visit any strip mall in Malton, Ontario, and count the jewelry shops. Returning to the CBC article, Barnaby added, "The sale was done in the normal course of business for the government. The decision to sell the gold was not tied to a specific gold price, and sales are being conducted over a long period and in a controlled manner." I find it curious that market price was not a consideration when selling off Canada's gold reserves. Leave it to the government to sell off essentially all of the gold during periods where the price of gold was at its lowest, particularly throughout the early 90s. Why was there such a great rush to sell off the gold, and so aggressively, and why couldn't they just wait for the prices to rise before they sold the gold? Hasn't anyone in the finance ministry ever heard of the concept of buy low, sell high? Where did these people get their economics degrees from? The CBC also sought comment from Don Drummond, an economist who served in the finance department in the areas of economic analysis and forecasting, fiscal policy, and tax policy, and whom Paul Martin reportedly described as one of the most principled and imaginative public servants with whom I have ever worked. In the article, Drummond states that he doesn't think it makes any sense for Canada to hold any gold because it hasn't delivered a good rate of return over time and it costs money to store. In response to Drummond's comments, Chapman also points out that while storage costs are a factor in holding gold, it should be noted that since 2000, gold has outperformed numerous assets, returning 335% versus 36% for the S&P 500 and 59% for the S&P TSX Composite. Since the world was taken off the gold standard in August 1971 by former U.S. President Richard Nixon, gold has moved from $35 US per ounce to about $1,270 per ounce today, a return of 3,528%. The Dow Jones Industrials closed at 898 on August 31st, 1971, and today sits at about 17,000 for a return of 1,793% before reinvestment of dividends. Meanwhile, Global News sought comment from economist Ian Lee of the Sprott School of Business at Carleton University, Ottawa. According to Lee, Ottawa has no real reason to keep its gold reserves other than adhering to tradition. He argued that there are better assets to focus on, calling the government's decision to liquidate its gold reserves wise and astute because it gives them more strategic flexibility to sell the gold, take the money, and invest in US government bonds or United Kingdom bonds or French bonds or German bonds. He added that central banks can hold the government bonds of other countries, and they also hold actual dollars. The Chinese central bank actually holds hundreds of billions of US dollars. Dollars are very liquid, so are government bonds, especially of a Western country. In a subsequent article, Lee stated that while the decision to sell off Canada's gold reserves might upset whom he referred to as gold bugs, he believes there is no reason to keep the reserves, calling gold an anachronism. Regarding the United States and Germany holding the world's largest gold reserves, he theorized that the US is holding onto its gold due to what he called gold nuts in the US Congress, referring to US politicians Ted Cruz and Rand Paul. Well, I guess we know where those guys got their economics degrees. Looking back, a 2003 Finance Department report stated, in 1980, the government implemented a policy of selling its gold at a gradual and controlled pace to enhance the return for the EFA. Proceeds from gold sales were invested in interest-bearing foreign currency assets. The report also states that this policy has greatly benefited Canadians. Since the start of the gold sales program in 1980, reserve asset income has been $13 billion higher than it would have been had the government maintained its gold bullion. Now, I'm not equipped to argue whether or not that was a good policy, but I do know that if the government had held on to just the gold reserves it had on January 1st, 1980, those reserves would be worth about $75 billion today. And as we have seen throughout the life of this policy, international reserves would increase well beyond the revenue that was obtained from the sale of gold, so clearly additional funds for the EFA were coming from elsewhere, and towards the end of this policy, the proceeds from the sale of gold were pretty much negligible anyways, in comparison to the expansion of the international reserves. A 2014 report states that, in regards to the 1980 policy, in addition to improving the overall liquidity of the foreign reserves, the purchase of high-credit quality fixed income securities with the proceeds of gold sales reduced the volatility in the value of the reserves and provided the government with interest income that compounds over time, which is not the case for a commodity such as gold. However, while those assets may provide the government with compounding interest, I would like to reiterate once again that since 1971, the price of gold has increased by nearly 10,000% to date. In 2022, former Bank of Canada Governor David A. Dodge was interviewed by David Lynn of Kitco News, and when asked about the decision to sell off all of Canada's gold, Dodge explained that the issue is quite clear. It costs to hold gold, whereas holding US or Chinese or Euro bonds gives you a return. And so the sensible thing, looking forward, was to hold reserve assets in the form of claims on other governments, rather than an asset which was costing us money to hold. So that was the strong view, and a view that our international monetary system was in place, that was sufficiently robust, that holding this antique instrument of stability called gold really didn't make any sense. Lynn followed up on these comments by asking, you wouldn't support the view that gold, being an entity held outside of the control of any one particular jurisdiction, is not privy to international and or domestic turmoil. It's not volatile like other assets. It provides that inherent stability, no matter how antiquated it might be, and so governments around the world have, and currently still do, rely on it as an anchor for their reserves. That's not a view that you've shared. To which Dodge replied, no, it is only an anchor in terms of the price of that particular asset. So what people talk about anchoring is trying to anchor the prices that you and I see in the marketplace every day. And the best anchor we have found in modern times is to target keeping that inflation rate at 2% in terms of monetary policy. Frank Giustra, CEO of the Fiore Group, offers a critique of David Dodge's comments in an opinion piece published in the Toronto Star soon after, pointing out that while storage costs are a factor in holding gold, it should be noted that since 2000, gold has gone up sixfold and outperformed numerous assets, including the S&P 500. And worse still, the bond returns Dodge was referring to have hovered close to zero since Canada dumped its gold. In an effort to understand why the Bank of Canada might continue the policy of holding zero gold reserves, Giustra consulted Martin Morenbild and writes, from his perspective, Canada does not need to own gold because, as he sees it, the Canadian dollar is a satellite currency to the US, making Canada part of a US currency bloc. If the Bank of Canada ever needed liquidity, it can tap into the swap lines that it has with the US Federal Reserve System. Giustra explains that swap lines are agreements between central banks to exchange their country's currencies with one another, used to stabilize markets when markets become stressed. Given the US has the world's largest gold reserves, Morenbild reasons that we can basically ride on America's coattails and likens the US currency bloc to Europe and its EU currency bloc. Giustra notes that while this is a fair point, unlike Canada, even the smallest partners in the EU bloc own gold. Germany, the dominant economic partner in the EU, has 3,300 tons, and tiny Portugal owns 382 tons. Giustra continues, riding America's coattails is all fine and well, but what happens if the US experiences a US currency crisis as a result of either its reckless debt growth or its massive money printing, or worse still, an internal civil war? Should Canada go down with the ship? Morenbild believes that scenario is certainly possible, and if that were to happen, the US would be forced to provide some gold backing once again to its currency, as it did prior to 1971. That's why the US will never sell its current gold reserves. That said, Canada and the Canadian economy would be banking on an America with a rational and functioning political system, which by today's standards is not a very comforting thought. Those comments, written in 2022, have become even more pertinent in 2025, and we've seen how this reliance on the United States has all the potential to become a massive liability for Canada. Giustra also raises the issue of how Canada would be affected by a future monetary system reset, perhaps one led by BRICS nations, which, as he notes, have been both hoarding massive amounts of gold in recent years and also working to create an alternative trading currency to the US dollar, adding that since 1995, 46,000 tons of gold have gone from the west to the east. Since 2010, central banks around the world have been stocking up on gold, recently at an accelerated pace. Giustra ends by asking, why would they be doing this without some future purpose? Speculating, a likely reason is that a gold backing would give any new trading currency the credibility it would need to compete with the reigning US dollar. Now that we've seen Canada's approach, what approach have other central banks taken with their gold reserves? At the time of the final sell-off in 2016, the CBC reported, countries such as Russia, India, and China are currently bolstering their reserves. Central banks added 336 tons to their reserves in the first half of last year, a 25% increase from the previous year. Of course, Russia, India, and China are the three largest countries at the heart of the BRICS bloc, which has been working to supplant the US dollar and, as we can see, have continued to amass gold reserves in the years that followed. Meanwhile, other central banks holding significant gold reserves have largely maintained those existing reserves, with a few even increasing their reserves during this time. I am hard-pressed to find another central bank that has followed in Canada's footsteps. One country that serves as a perfect contrast to Canada is that of Poland. Starting in 2018, the National Bank of Poland, under the leadership of Governor Adam Glapiński, has made several significant purchases of gold, beginning with 25 tons in 2018, 100 tons in 2019, 130 tons in 2023, 90 tons in 2024, and as of May 2025, an additional 67 tons, bringing Poland's gold reserves up to 515 tons, surpassing both the European Central Bank and the Bank of England, ranking Poland, a country of about 37 million people, 12th globally in terms of gold reserves. Glapiński's stated rationale for why he believes that such a large gold reserve is necessary is that for him, gold remains the safest component of reserve assets, which, as he notes, is free from any direct link to national economic policies, resistant to crises, and retains its real value over the long term. He also describes gold as a symbol of stability that enhances our credibility in the eyes of investors and foreign partners. Looking further into the NBP's gold strategy, their 2023 annual report states that The bank's goal is for gold reserves to constitute 20% of official reserve assets, which they estimate would require about 600 tons to reach. Another component of this strategy is the diversification of storage locations. In 2019, after purchasing 100 tons of gold, the NBP arranged for this gold to be shipped from London to NBP vaults in Warsaw, and in the years since has consistently maintained just over 104 tons within their vaults in Poland. The bank also keeps about 1/3 of reserves in London and the other third in New York. Note that the 100 tons of gold shipped to Warsaw in 2019 has no connection whatsoever with the gold held by the Bank of Poland prior to the outbreak of World War II that was famously relocated to London, New York, and Ottawa following the German and Russian invasion of Poland. Control of that gold was simply passed on to the post-war communist government and used up many decades ago in order to finance the reconstruction of Poland. Additionally, according to the annual reports, some of the gold stored in foreign banks is placed in term deposits, which accrues interest that is paid in US dollars, which in 2023 amounted to just over 2 million PLN. So it is possible for central banks to earn a return on gold holdings, but comes at the cost of introducing counterparty risk. Furthermore, as the price of gold has doubled since these purchases started, the market value of those purchases has increased by an estimated $16 billion, though the NBP has no plans to sell. Oh, and fun fact, Poland's currency is the zloty, which translates in English to the adjective golden. Returning to the management of Canada's international reserves, we see that the arguments put forth by the bureaucrats and academics in support of the policy of holding zero gold reserves seem to focus on two key points. The first being that it costs money to store gold, and the second being that gold doesn't generate a return, which in their minds leads them to the conclusion that Canada should hold no gold at all and should only concentrate on foreign assets that pay interest. Beginning with the first argument about the cost of storing physical gold, to put it simply, the cost of storage is the price you pay for eliminating the counterparty risk that comes with holding another nation's assets. And I have to wonder, what happened with the actual storage facilities in question? Once the last of Canada's gold was sold off, what did they do with the vault the gold was stored in? Turn off the lights, lay off the guards, and call it a day? Are there other assets being stored in those vaults, such as the gold of other countries perhaps, as we saw with the case of the Polish gold reserves in World War II? Or maybe other valuable Canadian assets? Or are the guards being paid to watch a hole in the wall? I have the feeling that eliminating the gold reserves has not eliminated the storage costs. Moving on to their second argument, that gold doesn't generate a return, as we have seen, the price of gold has increased by nearly 10,000% since 1971. In the case of the Polish example, we saw how the value of those holdings increased by nearly $16 billion over the course of just 6 years. Of course, as long as the National Bank of Poland holds on to those assets, those gains will be unrealized, but hypothetically, some gold could always be sold off to realize profits. We also saw how the Poles placed part of their holdings in term deposits to generate some revenue. Looking more closely at the arguments that are put forward in favor of holding zero gold, I find it troubling that the arguments presented largely seem to ignore the most basic historical facts, trends, and statistical data, such as that every single fiat currency in history has and will become completely worthless, or that the price of gold has only gone up over the long term and is on the verge of surpassing a 10,000% increase since 1971. Those making the arguments also seem to ignore the actual performance of the assets they espouse and appear to be completely unaware of the risks those assets carry and that this policy imposes on the nation. Furthermore, I am also greatly disturbed by the apparent lack of understanding of even the most fundamental concepts of investment, such as asset diversification, the old adage of not putting all your eggs in one basket, or the idea of purchasing assets when they are undervalued and selling them when they are overvalued. In other words, buy low, sell high. Even worse, the deeper we dig, the more ludicrous their arguments get, such as David A. Dodge's belief that 2% inflation is something that exists in the world, or Ian Lee resorting to epithets such as gold bug, gold nut, Or the invocation of Rand Paul as if to say anything associated with Rand Paul surely must be evil. Does that include the toothpaste he brushes his teeth with? The apparent level of incompetence of both the bureaucracy and academia is most disconcerting, to say the least. One of my goals in preparing this presentation was to determine what risks or consequences the policy of holding zero gold could have for Canada, and a cursory evaluation of this policy reveals that there are indeed many. We already saw how the main risks associated with holding physical gold are largely centered on price volatility and the secure storage of physical holdings. In addition to gold, central banks will typically hold a variety of asset types such as US dollars, foreign currencies, bonds, IMF reserves, etc., all of which are assets issued by foreign nations or entities and all carry what is known as counterparty risk, which we touched briefly on earlier in the presentation. As a reminder, counterparty risk is the financial risk inherent in contracts wherein a party, such as a foreign government, may not fulfill their contractual obligations. In other words, the government that issued the bond you hold may decide they don't feel like paying you today or ever. In addition to counterparty risk, all of these non-gold assets are also susceptible to the risks of currency devaluation through inflation and money printing, though risk in this case might be the wrong word. As history has shown us, the devaluation of fiat currencies is a virtual guarantee, as every fiat currency ever issued throughout history has eventually lost 100% of its value. Even at this very moment, both the Canadian and US dollars, for example, have already lost over 99% of their value, and now we're just stacking on decimal places. We can see with our own eyes just how much value our currencies have lost in the past 5 years alone. Now, consider that the Bank of Canada currently holds about $70 billion in its reserves. What happens if the US ends up like Zimbabwe did back in 2008 and starts churning out $100 trillion banknotes? By the pallet, that $70 billion would be worthless. And while the suggestion that the US might end up like Zimbabwe seems ridiculous now, don't forget it was only a few years ago that the US Congress was floating the idea of minting a single platinum trillion-dollar coin as a possible solution to its fiscal problems. By eliminating gold from the Bank of Canada's international reserve portfolio and focusing only on US dollars, foreign currencies, bonds, IMF reserves, etc., the entirety of that portfolio is now subject to both counterparty risk and currency devaluation. By including gold in its international reserves, the Bank of Canada could reduce its exposure to these risks by holding an asset that inherently carries no counterparty risk and also acts as both a store of value and a hedge against currency devaluation through inflation and money printing, particularly as the price of gold tends to rise in response to the depreciation of the US dollar. Thus, the old adage of not putting all your eggs in one basket still holds true to this day, but apparently no one told the Bank of Canada. Aside from increasing exposure to those risks by holding zero gold, the Bank of Canada also deprives itself of a valuable tool that it can use to respond to market and geopolitical volatility, while also affecting the nation's creditworthiness by lowering investor confidence. Furthermore, as Frank Giustra discussed, the Bank of Canada's policy appears to be reliant on the so-called swap lines with the United States, but as we've watched Canada-US relations deteriorate throughout the first half of 2025, reliance on the United States may prove disastrous for Canada. One final concern with this policy is the question of how it will limit the Bank of Canada's ability to adapt to future changes in the international monetary system in the future. Consider that a new monetary system emerges about every 40 to 50 years, and at this very moment, we're about due for a change. Any new system that wishes to compete with or even supplant the US dollar may incorporate some form of a gold standard in order to give this new system credibility. When countries like China, India, Russia, Germany, and France hold so much gold, what are the odds that those countries will just ignore the massive stockpiles of gold they hold when a new monetary system finally does emerge and not attempt to incorporate gold into that new system? In such a scenario, what happens to Canada? I don't know, but I bet they do. Another goal of mine in preparing this presentation has been to determine who exactly is responsible for imposing this policy on the nation. According to a 2003 Finance Department report, in 1980, the government implemented a policy of selling its gold at a gradual and controlled pace to enhance the return for the EFA. If that's the case, then which government implemented this policy? Consider that the enactment of this policy appears to commence in January 1980, when we see the first gold sales take place following 2 years of gold reserves being maintained at a relatively constant level. Yet, these sales also begin at a time when Joe Clark's short-lived minority conservative government had already been defeated a month prior on December 14, 1979, after failing to pass a motion of confidence. This in turn led to an election being held on February 18, 1980, which saw Pierre Trudeau's Liberals emerge with a narrow majority, and with Trudeau and Finance Minister Alan McEachern being sworn in on March 3rd. One constant during this time, however, was Bank of Canada Governor Gerald Bowie, who had held that position since February 1973. So again, who implemented this policy? A 1999 Bank of Canada report explains that the Exchange Fund account is the principal repository of Canada's official international reserves. The EFA is governed by the provisions of the Currency Act and is held in the name of the Minister of Finance. The Minister of Finance approves the general policies related to the management of the EFA and provides an annual report to Parliament on the operations of the account. Consulting the Currency Act, Section 17.2, Power to Acquire, Sell, etc. states, the Minister of Finance may acquire or borrow assets to be held in the Exchange Fund account and sell or lend those assets in order to carry out the policy. A 2016 Global News report on the sell-off of Canada's gold quotes a Bank of Canada spokesman as explaining, Canada's gold reserves belong to the Government of Canada and are held under the name of the Minister of Finance, adding, decisions relative to gold holdings are taken by the Minister of Finance. However, in addition to the Minister of Finance, a small army of faceless bureaucrats is also involved, as responsibility for the management of the EFA is jointly shared by the Department of Finance and the Bank of Canada. The Bank of Canada, acting as a fiscal agent for the Minister of Finance, effects transactions for the account. Furthermore, the Director, Financial Markets Division, Department of Finance, and the Chief, Financial Markets Department, Bank of Canada, are also responsible for the ongoing management of the EFA. A policy committee comprised of senior management of the Department of Finance and the Bank of Canada in the form of the Assistant Deputy Minister, Financial Sector Policy Branch, the Department of Finance, and the Deputy Governor, Bank of Canada, meets semi-annually to review developments, approve major policy initiatives, and provide guidance and accountability on the management of the account. So with that in mind, what happened in 1980? Did Joe Clark's Finance Minister John Crosbie decide after their government was defeated that Canada should liquidate all of its gold? And if this policy does originate with a short-lived minority conservative government, why would the majority Liberal government of Pierre Trudeau maintain a policy implemented by an unpopular government led by an ideologically opposing party? What if the gold sales we saw in the first months of 1980 were just coincidental to this inquiry and were in fact carried out in the normal course of government business? After all, the Soviet Union had just invaded Afghanistan, and rather the sales that occurred after March 1980 were the result of this policy, and it's actually Alan McEachern, acting under Prime Minister Pierre Trudeau, who is the progenitor of this policy. If that really is the case, then I find it rather curious that a policy started under one Trudeau should be completed under another Trudeau 35 years later. Some might call that poetic, others might call it conspiracy. But something is still not adding up here. Here we can see all 15 ministers of finance over the past 45 years, along with how much gold was liquidated during their tenure. Curiously, just as much, if not more, gold was liquidated under conservative governments as under liberal ones. Likewise, here we can see all of the prime ministers and governors of the Bank of Canada during this period and how much gold was liquidated during their respective terms. If the policy to liquidate all of Canada's gold reserves really did originate with Liberal Trudeau, then why the hell did conservative Mulroney and his finance ministers Michael Wilson and Don Mazenkovsky not only conserve Trudeau's plan, but dial it up to 11. And if this really was a Liberal plot, then why did Harper's Conservatives also conserve that plan and not reverse this policy by adding to Canada's gold reserves during their tenure? How is it possible that for the past 45 years, and even regardless of party affiliation, every single one of these prime ministers and finance ministers, as well as every successive governor of the Bank of Canada, should be in perfect lockstep concerning the complete liquidation of Canada's gold reserves? How has this policy persisted for over 4.5 decades, even as the price of gold has reached record highs, or in response to any of the significant economic and geopolitical developments that have taken place during this time? Not even Y2K, 9/11 and the global war on terror, the 2008 financial crisis, the 2020 pandemic, or the 2022 invasion of Ukraine were able to convince those in charge to change course. So it would appear that the answer to the question of who was responsible is all of them. They are all responsible for putting Canada in this position. And while this plan does appear to begin and end under a Trudeau, ultimately they have all worked against the national interest. There's a word for that. I still find it hard to believe that every single politician and official to hold office in the past 45 years should be in perfect lockstep with a policy that only appears to be detrimental to the national interest. It also disturbs me greatly that all of the bureaucrats and academics advancing this policy seem utterly incapable of making rational and convincing arguments in support of it. This policy becomes even more perplexing when you take into consideration that none of Canada's economic and political peers, such as any of the members of the G20, for example, have implemented that same policy. What does Canada's ruling class know that the rest of the world's great powers don't? All things considered, I can only come to the conclusion that there's something going on here, and it's either incompetence or malevolence. I'm sure many of you have heard of the so-called Hanlon's razor, which states, "Never attribute to malice that which is adequately explained by stupidity." I find this precept to be extraordinarily naive, particularly in light of the sheer consistency behind so much of what is going wrong in the world today. And in the case of Canada's gold reserves, I have a very hard time dismissing 45 continuous years of bad policy to simple stupidity. Instead, I prefer what we can call Forrestal's razor. That is, an observation made by former Secretary of the Navy James Forrestal to Senator Joseph McCarthy in 1946 in an attempt to explain how U.S. diplomats managing relations with the Soviet Union could have mishandled affairs so badly. Forrestal pointed out to McCarthy that consistency has never been a mark of stupidity. If they were merely stupid, they would occasionally make a mistake in our favor. Thus, taking into consideration the utterly inconceivable levels of mismanagement I've observed from the entirety of Canada's political, bureaucratic, and academic classes, I believe that all the evidence here points squarely to malice. And going forward, extraordinary proof of the contrary will be demanded from anyone claiming that they were merely stupid. Anyhow, be sure to like, share, and subscribe, and check out my Canada playlist for my presentations on Canada's housing crisis and future installments on other Canadian issues. Until the next one, thanks for watching.